It doesn't matter how great your idea is or how big the problem is. If you don't have a way to reach your audience in a cost-efficient way, there's just no business here.
My guest today is Jenny Feelings of Everywhere VC. They have invested in more than 300 companies globally, and there is not a continent on the world that they have not invested in.
You don't have to tell me the problem, because the problem has probably been pitched to me 10 times before. I've been doing this for a decade. Like, you're not coming up with that unique problems. What you're coming up with that's unique in consumer is your go-to-market. What are your channels? How are you doing this without, shoveling all your money to Mark Zuckerberg? That's interesting to me. In 2020, 2021, I was seeing a third of the companies I did not believe were venture backable. We have a 20-minute call, and all your job is to inspire me and get me excited, so I'll have another meeting. You're talking about vision, you're talking about why you're the ones to do it, and you're talking about the market opportunity, right? Those are your three biggest selling points. And what founders do is they think that their job is to talk about all the features they've built in the product. You got to stay high level, and you got to give me something to inspire me, not to educate. And if you're an early stage company and you're taking money from a fund that's raised $1 billion, the only way they can return a fund of $1 billion at a multiple, right? So let's hope they return a 3x. How are they going to return $3 billion is if I build my company into a multi-billion-dollar exit, right? And can I do that? And do I want to do that?
Welcome to the show, Jenny. Thank you so much for the time. How are you doing today?
I'm good. Thanks for having me.
Every single time we host anybody on the podcast, I ask them one specific question, and that's a question I want to ask you today is, what's the context you have of your life?
That's a big question.
Let's start with that, yeah.
You made it sound like it was going to be like, what's your favorite color? So the context of my life in 2 minutes. Came from a much more kind of traditional background, ended up in law school and in finance. And after kind of a few years in, seeing how traditional corporate works, I ended up kind of nights and weekends hacking on an idea that was really to solve a problem that I had, a personal pain point. So I call myself an accidental entrepreneur and an empath entrepreneur. So I was there trying to solve a personal problem that I had and working on it nights and weekends while I had my job at JP Morgan, and ended up really kind of coming to something that I thought had legs. Did a lot of customer discovery and saw that other people actually had this problem as well. And so in 2007, I started my first company. It was in the mobile voice over IP space. And it was really hard, right? It was hard to run a startup anytime. It was really hard, back then. It was hard to run a software company, not being out in the Valley. There were a lot of things that were hard. But I was passionate about what I was doing, and that wasn't hard. And so, once I got kind of a taste for tech and entrepreneurship, I knew that I would never go back. So I've been building and investing in companies now since that time.
Awesome. So, we have done like a lot of research, and how amazing things you have done. You've been to Techstars, you've been to PBC. Amazing things that you have done. But I want to ask you something which is very basic, so to speak. And the question that I have for you is, usually, early stage investment is pretty much all about, a founding team and the ideas, I think. That's what it's probably all about. But my question to you is, what do you look for in the founding team members before you make a decision? Like, I'm going to invest in them because there's like a few hundred of those that you have done. So what's the common pattern here?
Yeah, so I'd say that we're really looking for these three things. And as you said, I've been investing for a decade into hundreds of companies, and there's kind of a common thread of, what I think you need to be a successful founder and what I'm interested in investing in, which are, we can talk about that a little bit. We don't invest in every company that we think can be successful. We invest in the companies that, we feel like we can, help and work with and are excited about. So we're really looking for these, three things. First of all, we're looking for a resilient founder. Running a company is super hard, as I found out, and as many of your listeners, I'm sure, are experiencing right now. So this is a life's journey that will, on the short side will take you 10 years, right? On the long side could be longer than that. And so you just have to have that resilience, because you're going to have incredible ups and downs and, twists in the plot and pivots and just all kinds of crazy things are going to happen to you. And sometimes that's just in 1 week, right? So I think you need to be resilient to be able to deal with all of that. everything that's kind of coming at you as an entrepreneur. So I'd say that's like, thing one. Thing two is really looking for founders that have a vision of the future. And sometimes that future doesn't exist yet. And that's, where things get complicated, right? Because they're not necessarily solving a problem today, but they're solving kind of a future problem. And so they have like a thesis of where the world is going. And we're interested in those founders that have those big visions. And so oftentimes that might look like the market size is small because it's small today. But if you can paint a very compelling picture of, why that's going to expand because of this confluence of things, and those can be societal, and those can be technological, and those can be, socio, there's just like a lot of reasons why things change, then that's like a founder that we're interested, right? Those kind of visionary founders. And the last thing that we're looking for are, kind of what we call these fast founders. There are founders that are very responsive to data, and they're able to make decisions quickly. They're able to be decisive based on, gathering information. And so they're not, when you kind of give them some feedback on something, they're not like, oh, let me think about that. And then, they come back to you in a few months. We're really looking for those founders who can like take in that information and really act on it. And so we call those kind of the fast founders. And those are really the three attributes of founder that we're focused on.
Yeah. So 2 questions on that. So question number 1 is, how do you actually evaluate with just an idea without any data? Because it's a future problem. It's not a problem for today. It's a problem for, like, I don't know, when robots are blowing up or something like that. So how do you evaluate those ideas? Because to my mind, that's sort of a dream kind of a situation. Like, okay, in 20 years, if this happened, that happened, then we're probably going to have this thing. So how do you
what entrepreneurs all of that? If this, then that. So I don't necessarily think it has to be 20 years because that's going to be, hard on my timeline with the expectations of my limited partners. But, solving a problem today is fine. There's probably a lot of people going after it. But the bigger opportunity is, where are things going? And that's honestly why we invest in a lot of regulated industries. So we do a lot in healthcare. We do a lot in fintech, right? So these are industries that take a long time to mature, right? Because, there's a lot of regulation and there's, just a lot of bureaucracy and infrastructure as well. And so being able to penetrate that for a world that we'd like to see, right? Where all banks are digital banks, where, you just have to kind of imagine, right? There's no, there's no branches that we go into. You have to like paint this picture of what the world's going to look like in a few years. And then why is my product the best one to serve that customer pain point? So we're always looking at what's the customer pain point now, but even more importantly, in the future.
Did you guys end up investing in Bitcoin or like, cryptocurrencies or something like that? Because that was portrayed as a problem of future.
In 2015, I got interested in, just blockchain in general. And I ended up investing in a company called Chainalysis as their first investor. That's a blockchain analytics company. And everyone told me, at the pre-seed, well, seems like a great founder, seems like he has a really good vision, but market is small. And so, the unlock there was like, the market at that moment might have been small, but you have to look, in the future. And that future did, come to bear. And I think, yesterday, wasn't it, that the ETF was just, approved in the US. And it's like, if you would have told those people in 2015 that were telling me small market size, that we would have, a Bitcoin, ETF, I think they would have laughed me out of their offices, right? And so you need kind of those founders that see the vision in the future. And sometimes that's technology, and sometimes that's, that's shifting trends. So we started investing in kind of what we saw the future of work looking like, way before COVID, right? So that's been like one of kind of our key areas, because we believe in, kind of distributed workforces and all of these trends. And we'd started to see that, in 2018 and 2019. Obviously, it got accelerated in 2020. So, you're looking for those founders who kind of see the world that's coming.
Are you still thinking that there's going to be more blockchain/cryptocurrency related products in 2024, 2025 going forward as well? You see they're going to come up, they're going to emerge as well?
Sorry, more crypto?
yeah, more crypto slash blockchain companies gonna come.
Yeah, I mean, I think like I've already lived through two exciting cycles around this, and there's been one before I was even around, but the first one that I got to experience was, kind of the 2015, 16, 17. Then, went into a crypto winter. Then we emerged again in 2020, current crypto winter. So, I think it's coming back. Hopefully, the difference now, I would hope, is that we really need to think about utility for the user, the end user. So it's great to build technologies and talk about, how systems and rails should be built. But if there isn't a use case for the end user that makes their life better, then we have a problem, right? So I'd say some of the infrastructure that touches on crypto that we've invested in recently has been in the payment space, right? Because we think there's a massive use case for international payments that can be more efficient, less costly, and just use better rails than we have today. And that's a real value to end users that we can quantify. So,
Okay, great. So I just want to pivot a little bit towards, Everywhere Ventures, your company. So, we recently come across, and this was a funny term, not a funny term, intriguing term, which is many-to-many relationships. So you guys are different, like a lot different from traditional DLP structure or something like that. So you guys have more than like 500 founders who contribute to the fund. So 2 questions on that. So one is, how do you manage all those people? Like, how do you manage the expectation for like 500 LPs, which is a lot? Yeah. And the second part of the question is, why go down like this particular route and not stick to the traditional, DLP structure? Like why?
Yeah. So our structure is totally traditional GP/LP. We have a regular fund. It's pretty vanilla there. What's different is that instead of raising money from institutions, we raise money from individuals that those individuals are all founders and operators. So our demographic is different. Our structure is the same. The reason we do that is because we're founders ourselves, and we believe that, a fund by founders for founders has a differentiated angle. And we wanted to kind of bring that to market in 2018 when, funds, most of the people working at funds really didn't come from that demographic. So now I think you hear about it a lot more. There's a lot of operators and founders that are starting funds and running funds. But that was kind of our original thesis, that those are the folks on the ground that are seeing interesting deal flow, that are really well positioned to help companies because they have the firsthand knowledge. And if we brought those people together, both as LPs and as kind of members of our community, that we could provide something different to our founders, which is we don't take board seats. We're not calling them every week, but we're providing a platform that is fueled, shall we say, by this larger community, which is 500 founder and operator LPs, plus now another 250 portfolio companies. And so we've built out kind of a suite of collaborative tools for them all to interact with.
Amazing. So tell me a little bit more about that community. So like anybody can join that, or you guys just handpick all those 500 people? What are the expectations from, people can come in and a lot of people can come in, they can write like $50,000 check, but what do you guys look for? Like, okay, he's adding value, she's not adding a value, or maybe the other way around.
Yeah, I mean, we're looking for, kind of like-minded folks that are interested in having upside and participating in a community that's, about impactful companies. So we're not an impact fund, but we like to say that we're focused on world positive companies that are, doing something productive and good in the world. And so we're looking for folks that are also interested in that and that have operational experience. And yes, they've been handpicked. I'd say the other defining characteristic is that our LPs are located around the world, because part of our thesis is investing globally. And so if we don't have these folks in South Africa, in Sao Paulo, in all of these places, then we're not getting the deal flow funnel that we need to execute on that strategy.
Okay, awesome. So now that you have mentioned, the fund is global and all that, so there's a host of questions that I want to ask you around that. Because usually that's like part of the thesis. A lot of fund has like, if you're not incorporated, suppose in Delaware, we're not going to be investing in you. If you don't do this thing, we're not going to be investing in you. You have to be willing to move to the UK or Europe or something. So first question that I want to ask you is, because you guys are global, and I was like, we were going through your portfolio company. So you were like, I think like across every continent that I could think of, you guys were there, Australia to, Asia and Middle East and everywhere. So the first question is, how do you guys do the due diligence? Because now that there's like so many companies that you're investing in, every country/continent have different rules, different regulations. So how do you guys do that?
Yeah, well, again, the companies are being surfaced through our trusted network of founders we've invested in and founders who've invested in us. So by the time it gets to my co-founder and I, like if you think of diligence as a funnel, like it's already kind of gone through one vector of, okay, these are like good people that we can trust. I'd say the second vector that we look at is like, are these industries, again, that we think are interesting and growing? And so because we have so many of these folks, like, between our founders and our LPs, like almost 1,000 founders, like we can very quickly go out, if it's a healthcare company, send it on our Slack channel to 50 healthcare founders who can give us some very, quick directional feedback. All right. And so that feedback is like, oh, Jenny, I've seen a million of these, don't bother. Or, this is pretty interesting. You should look at this. Or, the best response I get is like, wow, I really like this. I'd love to take a call with them, right? Because these folks are intellectually interested. They are, also like just want to see success of other founders. So, those are the kind of two vectors of diligence. And then, on the regulatory side, the truth is that we're using like very simple documents, and we're usually not dictating much of the terms. So, a lot of the companies internationally are also set up as U.S. entities or entities that we're quite familiar with. So whether it's like a Cayman Holdco, Topco, or Singapore. And so there's kind of a few geographies that we're well versed on, and we have folks that, can help us, look at documents and that. But for the most part, these are all pre-seed. They're not really very many price rounds. They're mostly happening on safes.
Okay. Yeah, that's helpful. So in terms of, pitches that you guys going to be getting, it like that must be through the roof. So maybe 10 times more than a traditional pre-seed fund, or maybe even more than that. Can't even imagine. So two dumb questions on that, like very childish questions. So one is, how do you guys go through all that list? And then because that's a pretty wild list, so to speak.
Yeah. Well, when we set up the fund, we said like, how can we build a fund that's different from the ground up? And one of the things that we did was we built the fund to be asynchronous and fully automated. And so whether it's, our Airtable or our Slack channel or any of the CRM tools that we use and have, built, we're able to kind of run this fund 24/7 without having a traditional Monday meeting where everyone needs to come into the office to discuss deals, how it used to be done, especially, in Sand Hill Road. And so we're able to look at deals, evaluate deals, even vote on deals asynchronous through all of the tools that we're using. And so the way that we collect diligence, also a lot of it is kind of async. I don't necessarily need to get on a 30-minute call with a founder to talk about it, because we can, jam back and forth on WhatsApp when it's the middle of the night for him and morning for me, right? So I think that's one of the unique elements that we've tried to bring to venture, is it doesn't need to be this kind of stodgy business. We can adapt some of the startup, tools and strategies as well.
Yeah, isn't that like sometimes a little too risky? Like, I was reading somewhere. I think you guys are doing a deal every week or something like that. So that's like a lot of volume. So did you guys ever
Yes.
think about like, oh shoot, shouldn't have invested there? Because I can't see a scenario where you guys can say, oh, we missed this one, because you are pretty quick in investing. So did you ever guys have any setbacks or something like, oh, should not have invested in that company?
Yeah, I mean, there's no investor who's going to tell you they don't have regrets about investing or not in a company. If they do, please send them my way. But our model is based on high volume. And we have built a model that actually works and can, return value to our stakeholders, our LPs, based on this high volume model. And we do know at the seed, especially doing high volume where we're not just investing in 5 companies a year, that there'll be a lot of companies that don't work out. But that's okay. Our model can support it. And the truth is, we've backed companies multiple times. So we have companies from Fund One that shut down and didn't work, great founders, and we were able to invest in their next company in Fund Two. And some of those are really high performers. So, we're not so worried about that because our business model can support it, which is different, right? If you have a fund, and you're only taking 10 bets in that whole fund, like you got to make sure that there are a few that really work out. For us, we, have studied and have really leaned into the power law. And we understand that there's a small number of companies that can return the funds. Our funds are relatively small. And that it's more important that we don't miss a company than we take a bet that doesn't work out.
Okay. All right. Awesome. So Jenny, what we do is you've already seen that, I think, on LinkedIn. So we have a decent big of a community, the news and the other way around. So we send out like everybody, hey, Jenny Feeling is coming on the podcast. So send us all the questions. So we got a lot of questions. Thank you to all those people that send that. But we've managed to skim it down to like 5 or 10 questions.
Right.
So yeah, I just want to ask them because the podcast is primarily for first-time founders, second-time founders who are still starting out in this journey. So yeah, let's just start with them. The first one, which is kind of my favorite, is what's the biggest mistake you have seen first-time founders make when they're pitching to VCs, and how can they actually avoid that?
Yeah, I'd say the biggest mistake is that they get down in the weeds quite quickly, right? And so you set up a 30-minute meeting with an investor, likely on Zoom. You spend the first 5 minutes getting your headset set and wasting that. You spend the next 5 minutes making pleasantries and talking about the weather. So now we're down to 20 minutes, right? And so we have a 20-minute call, and all your job is to inspire me and get me excited so I'll have another meeting. And what founders do is they think that their job is to talk about all the features that they've built in the product, right? And so the biggest mistake that I see is you got to zoom out, you got to stay high level, and you got to give me something to inspire me, not to educate me, right? I'm probably doing somewhere between 5 and 12 of these pitches per day. And so when I, turn my computer off at night, why am I going to remember yours? It's not going to be because you gave me the intricacies of like one of your features. It's going to be, again, because you told me about a world that doesn't exist. And I was so kind of taken by that I'm still thinking about it.
Okay. Awesome. And how can they actually do that? Like, how can they zoom out and share the vision with you? What do you want them to share with you, like in specific? So maybe somebody who's listening is going to reach out to you, or she's going to reach out to you, and you're probably going to be blown away with their vision.
Yeah. I mean, again, like you want to have a concise pitch that you can kind of get through in, 1 or 2 minutes. And you want to kind of hit on, all the things that, you talk about in a deck, but you don't want to get bogged down by any, right? You want to make sure you're talking about vision, you're talking about why you're the ones to do it, and you're talking about the market opportunity, right? Those are your 3 biggest selling points when you're talking to an early stage investor, right? I'm a pre-seed investor. It's going to be very different if you're pitching a Series B investor. But if you're talking to an early stage investor, you've got a quick Zoom call. It's the first one. Like that's all you need to do.
A question which is not like planned, but just want to ask you, do you guys do follow-up rounds as well? Or do you just stick to the first money in and that's all about it?
Yeah, we write one check at the early stage.
Okay, awesome. All right, so the next one is, how much should first-time founders optimize their business for investors versus their customers when they're just starting out?
I mean, that's a very easy one. They should not optimize anything for investors. So you should think of venture capital money as just, rocket fuel to help something that's working go faster. Or at the very beginning, if you need a little bit of money to get going because you need to hire some engineers, etc., that is also a use case. But I think there's a misperception really of what venture is for. It's to help you put your foot on the gas. And only you can determine and your customers can determine where the market opportunity. The investor should hopefully know less than you as the founder.
Okay, awesome. So we're really going through all of them pretty quickly. So yeah, what's so great about working with founders from 0 to 1, like that particular initial phase? And a personal question that I want to add on top of that is, do you think, being the first money in is somewhat of a moat that you guys have?
I mean, I love working with early founders, probably because I started my company and I really didn't have, great mentors, advisors, early investors who could support me and help me. So I think, when you have someone who believes in you from day one and can provide support in different ways, and what we provide is different. Again, it's not the weekly hour call, it's the platform that we've built in the community. I think that can be a really big unlock for founders, and so that just gets me really excited, and that's why I do the work that I do. And then your question about a moat. There are very few pure pre-seed funds, I would say. Like everyone does pre-seed through, whatever seeds and A's. There's a lot of those. There's a lot of multi-stage funds. There are very few like pure pre-seed. I can probably count them on fingers and toes around the world. So, I think that we all kind of stick together. We syndicate a lot of deals. There's a few other early stage pre-seed funds. We probably have done, 30 deals there, right? So it's a very collaborative community at the early stage. And I think that's what's so beautiful about it. Not really looking for a moat, I'd say. Doing the work that I love to do. And I think there's a market for it. So as long as founders want to take my capital and work with me, I think I'm in business.
Okay. Another question on top of that, because one of the things that you mentioned is, so early stage VCs are pretty collaborative. Later stages are not. Maybe the growth stage VCs, they're like kind of in a competition more so than in collaboration. Why do you think that is so?
Well, the model is just different, right? So if you're a series of Bs and Cs where there's you're able to make the math work, meaning each investor needs to get their 10 to 20%, where you can have more than one, right? So it's hard to do that because then the founder is just giving up too much equity. So the math is just hard, and that's all it is. At the early stage, most of us are not ownership driven, and so there's enough to go around. The valuations are relatively low because there is a lot of risk involved, and we can be more collaborative. So that's really exciting, and there's enough room on the cap table at that early stage.
Okay, awesome. All right, so the next one is, what are your 3 best portfolio companies, and what did you see in each one of them, the founding team, I think, that they're talking about?
I don't really want to talk about individual companies, but I'll say, some of my best companies have been founders that have real deep expertise in their space. And so whether it was a pet insurance company, a crypto, company, or a mental health company, they've put together a team that really understands the space, understand what the problems are, because they are doing it from experience potentially that they had, and a work experience. So I think some of the most exciting portfolio companies are ones that come from that demographic.
All right, cool. What's the average time span looks like for your fund? Like the moment you invest and the moment you get something out of that, like what's the time span looks like?
Yeah, so we're early stage. So our fund is a 10-year fund. So we expect realizations within 10 years. And obviously, companies that don't work out mostly don't work out before that. And then early acquisitions. And so we've had, a few of those as well. But, we expect realizations, in 10 years.
All right, awesome. So do you believe in pitch decks, or are you kind of a person who just, happy to have a warm intro? And if you believe in pitch deck, which pitch actually stands out for you, and why do you think so?
Yeah, I think you need a deck if you're raising capital. That is the currency that we deal in, and it helps us quickly get up to speed on your company. So before I meet with a company, I always ask, just send me your deck or your memo, because I want to kind of better understand what it's all about, because you want me to be educated. Again, we only have that 20-minute window I talked about, right? So I need to be up to speed so you can really maximize. If you need to start with definitions of what you're talking about, this is what quantum computing is, Jenny, it's going to be a long sell before I'm up to speed. So I think decks are really helpful. I don't think you necessarily need to go through a deck during the pitch, though. And so that's the difference. I think it's always good to just ask the investor, do you prefer to keep this, casual, or would you prefer a deck? And everyone will have their own preference. So I think you should be ready to present a deck, and really only spend 10 minutes on that. So you got to practice. Most founders cannot get through their deck in 10 minutes. but that's all the time you have, right? So we have our 20-minute window, like, because that's all that's left in the time. You do 10 with the deck, and then 10 you have to answer questions and have some engagement. So I think that's a great way to do it. Otherwise, just give them, as I mentioned before, kind of a 2-minute pitch, a 1-minute pitch, and then you're kind of, the investors already up to speed because they've read the deck, and they're just going to go in and start asking you questions.
All right, awesome. So a follow-up question on top of that is, so what's the decent, pitch deck structure to you looks like? Like what are the must-haves in any pitch deck?
I think you can find that online, right? That's like just, the basics. You need your market, you need your, your vision, you need your go-to-market, competition. So I don't think that's the ingenuity is what are the slides. I think what distinguishes a good deck from a not good deck is a narrative and a story, right? So all those slides, whichever ones you pick, because it doesn't really matter, they need to tell a story where I get to the end and I feel like, oh, that actually makes sense. So every slide needs to be connected to the other slide in a way that flows and tells the story. So that's kind of the most important thing.
All right, awesome. So the next one is a very funny one, which is, what's an average VC attention span looks like? Like how long is that?
Well, there's been some data on this. I think DocSend did a little bit of analysis of how long seed stage investors were spending on decks, and I think it was like 2 minutes and 3 seconds or something. So, they're going to flip through the decks pretty quickly. I'd say I probably flip through a deck even more quickly than the 2 minutes. Again, it's just to give me a sense of what you're up to, who you are, and, one or two unique, things about you. What's the vision? How are you different? If you're a consumer company, like the first slide I'm going to go to is go to market, right? I don't care what you're building, doesn't really matter to me. How are you going to acquire customers? That's the most important thing, right? And so I think the investor will just zoom in on the decks that they're focused on, the pages that they're focused on. And I think that's kind of how it goes.
So why not the problem, and why the GTM right away for you?
Because if it's a consumer company, like, for me, it doesn't matter how great your idea is or how big the problem is. If you don't have a way to reach your audience in a cost-efficient way, like, there's just no business here. So I'm not saying that go-to-market needs to be an earlier slide. I'm saying that that's the only slide that I'm going to look at in your whole deck, maybe your team. So that's why investors spending so little time is like, you don't have to tell me the problem, because the problem has probably been pitched to me 10 times before. I've been doing this for a decade. Like, you're not coming up with that unique problems. What you're coming up with that's unique in consumer is your go-to-market. What are your channels? How are you doing this without, shoveling all your money to Mark Zuckerberg? That's interesting to me, right? What are your channels? What's your distribution? How are you thinking about CAC? What are the channels you're leveraging? What are the partnerships? That's all I want to know in a consumer deck.
All right, awesome. So one question which I think is going to be related to your statement, like not sending every money to Mark Zuckerberg, is that why so many companies got shut down in 2023?
We had kind of a confluence of things happening during 2020, 2021, which we call the ZERP era, right? Zero. And, a lot of cash was chasing, any deal that was out there. So a lot of companies were getting funded that probably shouldn't have been funded, or they were good companies, but they got funded at crazy valuations that they couldn't sustain, right? They had no revenue, and all of a sudden they were raising a first round at a $20-30 million valuation. It's very hard to grow into once like multiples and actual revenues and a methodology for valuation makes sense. So I think kind of the rug got pulled out pretty quickly as the economy started shifting, as interest rates started rising quite heavily. There was just this kind of confluence of things happening. And all of a sudden, founders got a little bit caught, the ones that had raised money at high valuations, or were paying expensive talent, or, just overspending, right? So there was just a lot of things going on, and it felt like this kind of bubble had burst. But the truth is it had been building for many years. And it just, the business had gotten kind of over its skis, and companies weren't focused on fundamentals anymore. How are we going to make money? And they thought that, living on venture capital was a way to go. And it just isn't. Again, it's the rocket fuel when something's working. It's not the crutch to kind of get you there.
Yeah, totally agree to that. Um, what do you think 2024 is going to be different from 2023? How do you think it's going to be different for venture capital and startups?
So, my word for 2023 was turbulent, right? So there was just a
Okay.
lot of in the market. And my word for 2024 is resilient. So I think that we've had a lot of the carnage. Every investor like myself has had, carnage in their portfolio, companies that had to, shut down, companies that had to do major layoffs, had to get to profitability. A lot of the reckoning, I believe, has happened in 2023. And I feel like 2024, the ones, that are making it through have a real shot. And so I think this is the year where we'll see, who were the resilient founders and who were the ones that weren't, right? What were the business models that could be sustainable and which are the ones that weren't? Who are the founders that cut when they had to cut, when they didn't want to cut, to reduce their burn, and who are the ones that didn't? So I'm optimistic that not that we won't have some bumps in 2024, but that we have kind of reset into a healthier place, and that going forward, at least for the next few years, till we forget everything that we've learned in 2023, we might have a little bit more sanity.
Okay. The next one is one of my all-time favorite questions, and that is who should raise money and why they should raise money. Institutional money, let's suppose. Yeah.
Yeah. So I think if you have ambitions to build $1 billion company, you should by all means raise venture capital. And if you have ambitions to build anything less, you should think about whether venture capital is right. It may be, but it may not be. So, whether you are bootstrapping, whether this is a small business that you feel like can ramp up quickly, there's lots of different ways to build businesses. And I think, the problem we've seen is that the kind of unicorn venture-backed company for many years got, overly hyped up and celebrated that was what entrepreneurship was about. And the truth is, this country that I'm in, the US, was built on small entrepreneurs, right? Mom and pop stores, your pizza shop, your accounting firm. That's actually, these are like real businesses. And that's what, this country was built on. And I think we need to kind of return to a time where we understand what's a small business that can use alternative funding, right? And those can access other types of capital. And what's a venture capital business that needs a certain type of funding, this rocket fuel that I've referred to a few times. And let's not stigmatize one or say that one is better than the other. And I think that's the mind shift we have to get back to is like, these are great. And you can actually build a massive $50 million cash flowing business that you own yourself and have a way better reality, lifestyle, and exit than, someone building unicorns where they only own a small amount, right? So I think we just need to reset the psyche in general that these two things are equivalent. Neither one is better. They're just different paths. And your path of what you're building and how you're building it determines your capital access, right? And so I think we just need to be honest with that. And so I'd say, in 2020, 2021, I was seeing, I would say, a third of the companies that I was seeing, 25% to a third of the companies I was seeing, I did not believe were venture backable. They looked like interesting companies, but I didn't understand how they could, grow into these kind of, massive outcome businesses that venture capital requires. And we require it not because, we like those businesses better or, we think they're cooler or whatnot. The only reason we require it because it's the only way that our business model works. If I have companies that are exiting for 50, 100 million, I can't return that money to my investors based on my business model, right? So, I think that founders need to be a little more proactive and understand the business model of the investor that they're taking money from. And if you're an early stage company and you're taking money from a fund that's raised $1 billion, you got to put on that hat for a minute and say, the only way they can return a fund of $1 billion at a multiple, right? So let's hope they return a 3x. How are they going to return $3 billion is if I build my company into a multi-billion-dollar exit, right? Because they're still getting a small slice of that. And can I do that? And do I want to do that? And so I think those are the hard conversations founders need to have with themselves before they go out and raise venture.
Yeah. I don't think like a lot of founders that I have met, and I've privileged enough to interview, I think 50 VCs or founders on the podcast. Like, I don't think a lot of people have that level of self-awareness where they can actually sit down, have that tough conversation and figure out like it's a choice. Both comes with like pros and cons. So yeah, I think this is definitely need to do something like that. Okay. So two more questions on that. So question number one is, what was it like working at Techstars?
It was magical, right? I was a founder before, and I got to really see the other side of the business. I got to work with entrepreneurs from around the world and build out the New York office. I was lucky to invest in some great companies, including a few that are unicorns. And I got to learn a skill set, which is doing venture at scale, right? So I learned how to synthesize information really quickly. To get to fast decisions. And then when I had this big portfolio, how did I just support this portfolio at scale? So a lot of, what I learned there, what I've taken, with me into my own fund.
Awesome. So the last one on that list is, as someone who's been a founder and just looking to start out in the investment world, what advice do you got for them?
Well, I think founders make great investors. So, you're halfway there. I think, venture capital is it's a niche industry, right? And so it gets a lot of play in the media, and it sounds really great and sexy, but it's a cottage industry. It's very small. There's not that many. And so traditionally you either had to be well off yourself so you could start your own fund, or you needed like a pretty significant track record to start. So I think, again, same advice as on the last one, like if you want to get into venture, whoever you are, you need to like look yourself in the mirror and say like, okay, it's going to be like a tough 10 years. Like I might not receive anything back. Like I might not get a salary for all those years. Like, can I do it? Right. And, it's hard. When I started out, I just told this story recently. I was in year 5 and I hadn't returned any money to investors, which makes sense based on our model, early stage. But I looked at myself in the mirror as someone that was always kind of a high performer, someone who was type A, someone that needed feedback. And this is not a game of feedback, right? And I thought, you know what? Maybe I should go back to founding companies because I'm not sure I'm good at this. I haven't returned any capital. And some of my mentors said to me, Jenny, it's a long game and, you got to be in it for a few more years before you see $1 back. And that was just really hard for me and very frustrating. I got very lucky at year 5.5. I ended up having a company that was sold to DocuSign and returned my whole fund. And all of a sudden I was like, oh, yes, venture capital works. But I almost, opted out in year 5. So the advice I'd give to anyone who wants to get into venture capital is like, can you go 5 years with no sense of whether you're good or not? No money coming back. And, do you have that type of resilience and grit? Because it takes that.
Okay, awesome. So Jenny, we do have one small ritual on the podcast. And what we do is we ask all our guests a question for our next guest without telling who the next guest is going to be. So we got a question for you. Obviously going to take a question from you for the next guest. So the question that the last guest left for you is, given what we already know about AI, artificial intelligence, how would you change the schooling system and what would you teach children so they're ready for the world that's coming ahead of us?
Oh, that is an intense question. Isn't everyone need to be a prompt engineer now? But it's been interesting just to see the swing we went. So when I was going through college, everyone was kind of in the humanities and liberal arts, and then, very much went to STEM, and everyone had to be an engineer. And I think things are kind of coming back now where we're realizing that these things are not so polar and that you actually need both of these skill sets, right? Like you need to, have both. And so I guess what I would say is, have a well-rounded education. I think understanding the implications of AI, seeing that as an opportunity. But I don't think that means, again, you need to go hard in one direction. I think we need both to have a good society.
Awesome. Thank you so much, Jenny. I appreciate the time and really lovely talking to you.
Okay. Thanks so much. It was so great to be here.
Thank you. This is it from today's episode. I hope you enjoyed it. Thank you so much for watching and listening. All the resources and links that we have talked about, they're all in the description or in the show notes, depending upon which platform you're on. If you're listening on Apple Podcasts, please give us a review. Would appreciate it. If you're watching it on YouTube, please mention down in the comment, did you like it? Did you not like it? What do you want us to improve? Who do you want us to invite on the channel? If you enjoyed this episode, there are chances you're going to enjoy that episode as well. So we're going to link it down somewhere here. Do hit the subscribe button if you haven't done that already. And thank you so much for watching again. And I'll talk to you soon. See you in the next one. Peace.